Hello and welcome to the first segment in our series on equity financing. We know that access to finance can be a major challenge for many small businesses. And here at DevSolutions, we found that many entrepreneurs really don't know their options for funding beyond a grant or a loan. So the idea behind the series then is to peel back the curtain, so to speak, and give you some key takeaways about equity financing. That way you can begin to think about whether this could be an option for your company and be inspired perhaps to learn a bit more. So let's jump right in and talk about equity financing and how it differs from a loan or debt financing. Equity financing is funding given to a company by its founders or owners, by its employees, or outside investors. These individuals expect to get their money back with a sizable profit, ideally, when the company is either sold or it goes public on the stock exchange. So what do I mean by going public? Well, an equity investment can either be a private transaction in a company such as yours, or a public transaction where the shares of the company are offered to the public through a listing on the stock exchange. This is known as an IPO or an initial public offering, and this can be a great way to scale a business. Debt financing, on the other hand, is a loan from an individual or a financial institution. This funding carries interest and oftentimes requires collateral, which could be a challenge for any small company without extensive financials, extensive assets, or a very strong presence in the market. Unlike a loan, an equity investment comes with an important advantage. It's known as smart capital. This means that in addition to the funding, an investor provides the company with strategic advice, with guidance, with access to networks, as well as access to best practices in things like corporate governance or just generally operating the company. This can be a win-win for any early stage company that's trying to firmly establish itself in the market and build a brand. Essentially then, smart capital or the right investment can take a company to an entirely new level. Most importantly, perhaps, it can pave the way to subsequent rounds of investment, either from the same investors or from new individuals. However, there are trade-offs, like most things in life, right? Unlike a loan, an equity investment and accepting this kind of funding means that you're giving up some control over your company in relation to the number of shares you gave up in exchange for the funding. This could have serious implications for your company in the sense that you might be ceding control or giving up control over key decisions, particularly if the investor negotiated a seat on your company board. So if your company is looking for funding, how do you decide whether an equity investment could be the way to go? I think you need to consider, first of all, the differences with a loan, and secondly, the trade-off between the benefits of smart capital and perhaps the disadvantages or potential disadvantages of losing control or some element of control. It's also important to note that because investors are looking for a high return on their investment, they're looking for a particular kind of company. They're looking at companies that have an innovative product or service which addresses a key customer challenge. These companies should also be able to service a large potential market and be able to scale successfully quickly. Besides the key criteria of innovation, market size, addressing a market need, and scalability, there are two other factors that are also very important. The first is the quality of the management team, and finally, whether corporate governance measures are already in place in the company. If I've piqued your interest in equity investment as a funding option for your company, I invite you to take our investment readiness assessment. This will give you an idea in a very preliminary way whether your company could be attractive to an investor. In our next video, we'll be talking about the equity financing process. Thank you so much for watching, and we look forward to your feedback and your comments.